Good morning. Today is Thursday, August 11th. Thank you for joining us. We're going to kick it off with more inflation data, and then we're going to talk a little bit more about a little bit of post-mortem from yesterday's inflation, what that means, what that meant for the markets yesterday, what that means going forward. And then we'll close with Disney earnings and a little bit of a preview of the retail earnings for next week. So that's the agenda for today. So Tom, let's kick it off with producer price index. Where are we?
So the expectation for PPI year over year was 10.4%. The last reading was 11.3%, and we came in at 9.8. So significant improvement, getting underneath 10%, which is definitely positive. The more interesting number, though, I think is the month over month change was the expectation was 0.2, an increase, and last month is 1.1. We came in at negative 0.5. So we actually saw some deflation in the PPI in the month over month number.
Yeah, and if you exclude food and energy, you're still up 0.2 on a month over month. Consensus, however, was looking for 0.4, and that's what we were last month. If I were to say, it seems to me that the PPI estimate was probably a little bit too high.
Yeah.
Having said that, it's good news. And if there is easing on the producer side, then that's good news for hopefully consumers because, the benevolent companies, when they see their costs decrease, they always cut costs for consumers, don't they?
Always.
So it'll be interesting to see what happens with that. I think it's good. It's good news. It's really good news for stocks because I think that it sets the stage for more margin expansion because a lot of these price increases that we've been talking about are baked in on the consumer side over the next 3, 6, 12 months. So I think that you might see a little bit more margins on the consumer side. Do we have a jobs number on an initial jobs claims?
We do. This one's actually kind of a surprise to me as well. So the surveyed estimate was 265,000 initial jobless claims. We came in at 262. What's important to note, though, is that last month was 260. It's been revised down to 248.
Okay.
So we're seeing
that's the first revision
there.
down that we've seen on the weekly jobless claims for a while. But it'll be interesting to see what happens with the 4-week moving average. It seems like that's still moving up, but maybe not as aggressively as it was. So overall, pretty good news on the economy over the last couple of days. The only concern now, though, is the Fed going to slow down its rate hike cycle and then potentially perpetuate more inflation? And also, is the consumer now going to have more confidence? And instead of tightening their belts like we were seeing in June and July, are they going to say, you know what, maybe things aren't so bad. Maybe we're not actually in a recession. Maybe we can actually go out and spend more money. In which case that might just perpetuate inflation further. And then you're kind of in this cycle.
Yeah.
So I think that's what I'm concerned about. And I think that's probably what the Fed will be concerned about too, which is why I think they'll continue to be foot firmly planted on the brake of the economy.
I mean, that's my expectation. I mean, there hasn't been anyone really that's come out of the Fed and said, hey, we're definitely slowing down. If anything, they've been more vocal about how much more aggressive they need to be. Neil Kashkari said, quote, "This is just the first hint that maybe inflation is starting to move in the right direction, but it doesn't change my path." And he's been pretty hawkish over the last couple of weeks. I mean, I think the right thing to do right now is to continue to put pressure on inflation, continue to raise rates. I think the longer they do that, the more likely we are actually to have a softer landing. I mean, I think that, despite my morbidity on the economy over the last 4 or 5 months, there are definitely signs of life. The jobs market continues to be surprising. I would say that the inflation numbers have been definitely positive. If we can keep the momentum going, I don't think we've hit the event horizon where we're going to get sucked down to 2% on inflation. I think that, we're starting to get over the side of the hill, but there's definitely a lot of forces that could potentially push us back up. So the question is, has the Fed got the gumption to keep the foot on the brake and really slow this economy to a point where we don't reaccelerate?
Yeah, we're in a tough position because the better the economy does, really, the worse outlook it is for continued Fed pressure on the economy and worse outlook for inflation going forward. So it's a rock and a hard place situation. So although we're getting good news on the economy and the economic front, I think the concern is, what does the Fed have to do to address this? Because frankly, I mean, if 500,000 people are getting hired and they're taking higher and higher wages. They're going to have more money. They're going to spend more. They're going to be less price sensitive. And when consumers less price sensitive, that begets inflation.
Yeah.
And I think that's the concern is, if we get more inflation because the consumer's in a better position, we could just perpetuate that inflation further. I would say, if you back into the average real hourly earnings for the month of July, we were still down 3% from the prior year. So the consumer's still not in very good shape. The Goldman indicator of the US consumer is that it contracted 0.8%. Consumer spending contracted 0.8% on a year-over-year basis in the month of July, same as June. So things are still not good, but they might be getting a little bit less bad, which again, if we were at 3% going to 2% inflation, that's a huge win, but we're 8.5%. We have a long way to go.
Yeah. People were panicked earlier this year when we were at 6%. And it's not the first month we've had a deceleration, which is why the May number was so painful. So this time, I think, rather than changing course, I think the Fed needs to stay strong here, and it might cause a lot more volatility. But I think in the long run, we've talked about it a million times. It's like heroin. Sometimes, going on methadone forever, is not as effective as just kicking it cold turkey and going through the withdrawals. And unfortunately, there's going to be a lot of pain there. But on the other side, you've got a lack of need for the substance, and then in this case, that would be quantitative easing.
Right. If you think about what you would do if you were the Fed, and what you think the Fed will do at the meeting on September 21st, do you think they're going to raise by 50 basis points or raise by 75 basis points? Because I think those are the two options on the table.
I think they'll raise by 75. I think that the market is thinking one thing, but I think the Fed obviously is not subject to what futures are doing. They can do whatever they want. And I think 75 basis points is the right choice here. I mean, there's definitely an opening. There's a little bit of a gap there where we can get in and be aggressive and maybe, slay the dragon. There's an open spot in the armor. And I think the move there is just to continue to be aggressive. I think that's the best way to get through here.
Yeah, I think it's a bit of an unfair question because it all depends on what inflation is in August. I think at the end of the day, we won't know until we know what the inflation number, the CPI number is for the month of August. Apologies for
somebody's over here playing with their new wedding ring, and they may have dropped it.
All right. So futures a little bit up on that producer price index number, and that seems a nice follow through from yesterday's rally that we're seeing this morning. We do have retail earnings coming next week, and I think that's going to be a key element of what the next big news item is in this market. And then it's probably going to be a few weeks of relatively slow news. You do have Jackson Hole, which is the big Federal Reserve summit. Jay Powell will give a talk there. That's when he moved from the inflation target to average inflation targeting, which was a big shift. And of course, they very quickly blew through that average with where they are in inflation right now. But next week, we do have some retail earnings. So we have Walmart and Home Depot on Tuesday. On Wednesday, we have Lowe's and Target. We also have Cisco, the technology company, in the evening. And then on Thursday, we have Ross Stores, and Friday, we have John Deere. So we may see continued follow through of this rally, because I would say that a lot of the companies that have already guided negatively for the coming quarter, that's already out there. We already know that news. Take, for example, Walmart or Target. And as you look forward for their guidance for next quarter, my guess is that they will be at least reasonably sanguine, because things have stabilized a little bit here in the last 4 to 6 weeks as you look at consumer spending. So those trends have stabilized, and I think that will probably bode well for the retailers next week. And then after that, like I said, it's going to be a little bit of a darkness just kind of in the market, not in terms of negative, but just not getting much.
Yeah, lack of new information.
And so the narrative will be the narrative in the market. It will kind of just follow the market on that. Tom, any thoughts on next week in terms of the retail earnings, and then we'll hit Disney?
Really, my only thought is that the target comes out a third time and lowers guidance. If I had hair, I'd pull it out. But I might ride up to Bear Parkway and burn that thing down because they've just been full of surprises and none of them have been positive
Not
this
in a
year.
good
So
direction.
yeah, if they do it a third time, I'll be very upset.
That would not be so nice.
Not so nice.
So finally, we're going to talk a little bit about Disney. And I think this was a very critical quarter for Disney. They had a very bad quarter last time. All they were doing was Disney Plus was going to be the savior of everything. It was going to be ad supported. It was going to be no ad supported. It was going to raise prices, and they were going to be international. And they're going to have different offerings, and they're going to be in more countries, and they're going to have different new content, and they're going to have adult content on there. They're going to have kids content on there. It is a lot simpler this time around. They basically just said, you know what, we're going to follow the Starbucks playbook. We're going to follow the Apple playbook. We are essentially saturated in terms of Disney Plus subscribers. What we're going to do is, instead of trying for the nth subscriber and spending marketing dollars and trying to attract them, what we're going to do is just raise prices. And they're raising prices a lot. 38% price increase, going from $7.99 to $10.99 for the ad-free tier.
I mean, I think Disney got a little off track, right? When looking at subscribers, the growth of Disney Plus, they kind of got into a business that wasn't their business, right? And I think this is a fundamental shift back. This is them basically saying, let's do the vault thing again, right? If you want to watch Sleeping Beauty, you got to come here, and you're gonna have to pay what it costs. And so we're raising that price. I think Disney has an excellent track record of taking things that are extremely mediocre and making people think that they're really, really awesome. And I think that that's what's happening here. They're in the spin zone. They're telling you that Star Wars is really awesome, but if you go back and watch those movies, they're a little bit boring. And I think that they're doing that with Disney Plus. It's not as awesome as it seems, but they're pumping everybody up, and the stock is adjusting accordingly.
Yeah, it's up 8% right now.
That was up 9.14 last I looked before we walked in here.
So, and the big thing is, they just said they're not going after, subscribers growth. They're not going after user growth, kind of like the same way Starbucks does. At some point, you have the stores that you're going to have. You have the traffic. You're not going to try to crowd the stores with more staff to make more frappuccinos. You're just going to charge more for the frappuccino. If the people are there, they'll pay it. Just charge more for it. It's a lot easier way to manufacture growth. Is that going to feed well into the inflation numbers? No, but it's the MO for some of these companies that have strong brands and that are able to monetize them. And part of having a strong brand is you have a lot of pricing power. Yeah. And Disney is not shy. They've never been shy about pushing that lever, and they're pushing that lever in a big way right now.
Yeah, I think it's a perfect play by them, and I think the stock is reacting the way it should.
Yep. All right. Thanks, Tom. Thanks everybody for joining us. We will see you tomorrow and close out the week. Bye.